macro currency signals.
Silver is not just rising because investors are excited. It's rising because the world is using more of it than ever before. This is the part most casual observers miss. When people check the gold and silver price in USD, they often think it's purely about inflation, interest rates, or Federal Reserve policy. But silver is different. Silver is money, yes, but it's also infrastructure. It's technology. It's energy. And right now, global demand is accelerating from multiple directions at once. Look at the energy transition alone. Solar panels require silver paste to conduct electricity efficiently. As countries race to expand renewable energy capacity, every new solar installation quietly absorbs more physical silver from the market. This is not speculative demand. This is industrial consumption. Once silver is used in these applications, much of it is not economically recoverable. It disappears into the grid. That creates a structural draw on supply that builds year after year. And when energy policy aligns with environmental mandates, that demand becomes policy-driven, not optional. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Now, let's come back to what just happened. Then consider electric vehicles. EV production is expanding globally, and silver plays a role in battery management systems, power electronics, and high-efficiency circuitry. Add to that the explosion of AI data centers, advanced computing, and next-generation telecommunications infrastructure. These systems rely on high conductivity and durability, and silver remains one of the most efficient conductive metals available. When technology scales, silver consumption scales with it. Now layer investor psychology on top of industrial demand. When the gold price in USD begins trending higher, silver typically attracts attention shortly after. Historically, silver has a higher beta than gold. It tends to move more aggressively once capital rotates into the precious metals sector. So what happens when industrial demand is already tight and investors suddenly start accumulating physical silver as a hedge against inflation, currency weakness, or geopolitical instability? You get a pressure imbalance. Physical supply tightens. Premiums expand. Spot prices become more volatile. And this is where it gets interesting. Gold is primarily held as a monetary reserve asset. Silver sits at the intersection of monetary hedge and industrial necessity. That dual identity makes it uniquely sensitive. When macro uncertainty rises, whether it's debt concerns, banking stress, or weakening purchasing power, gold often moves first. But once silver catches the move, it can accelerate rapidly because its market is smaller and more thinly supplied. When you see silver and gold prices in USD fluctuating sharply, understand that you're watching more than a chart. You're watching the collision between global industrial expansion and financial uncertainty. You're watching supply chains meeting investment flows. And when both forces point in the same direction, upward pressure, the result isn't gradual appreciation. It's explosive movement. Silver doesn't need speculation alone to rise. It has structural demand behind it. And when structural demand meets monetary demand, price doesn't ask for permission. It reprices. Now let's talk about the part of this story that makes the silver market truly dangerous: supply. Because while demand headlines grab attention, supply constraints are what create price explosions. Most people assume that if silver prices in USD start rising sharply, mining companies will simply produce more. That sounds logical. Higher price equals higher production. But silver doesn't work that way. Nearly 70% of global silver production comes as a byproduct of mining other metals: copper, lead, zinc, and gold. That means silver output is tied to the economics of entirely different markets. If copper production slows because of industrial weakness, silver supply drops with it. If base metal projects are delayed due to environmental regulations or capital shortages, silver production tightens automatically. In other words, silver supply is not agile. It cannot respond quickly to price signals. Now think about what that means in the context of rising gold and silver prices in USD. When gold trends higher, it often reflects macro stress: inflation fears, currency devaluation, debt instability. Investors move capital into hard assets. Silver follows. But unlike gold, where central banks hold large reserves and supply flows are relatively predictable, silver's market is thinner, tighter, and more sensitive to disruptions. Mining itself is also becoming more complex and expensive. Energy costs, labor shortages, geopolitical instability in key producing regions, all of these factors limit the ability to ramp up production quickly. New mining projects take years, sometimes over a decade, to move from discovery to full-scale operation. Exploration budgets were cut heavily during previous downturns. That underinvestment doesn't show up immediately. It shows up years later as constrained output. And then there's the issue of declining ore grades. Many of the world's high-grade silver deposits have already been mined. What remains often requires more capital, more energy, and more time to extract the same amount of metal. So even if silver prices in USD double, that doesn't mean supply doubles. The physical reality of mining acts as a bottleneck. At the same time, physical inventories matter. Exchange-traded inventories and wholesale vault supplies can shrink quietly before retail investors notice. When industrial buyers step in to secure long-term contracts and investors simultaneously demand physical delivery, available supply tightens fast. That's when premiums expand. That's when volatility spikes. That's when the market begins repricing risk. Gold's supply structure is different. Gold is primarily hoarded. Most of what has ever been mined still exists above ground. Silver, on the other hand, is consumed in industrial processes and often not recovered economically. Over decades, that consumption reduces accessible above-ground stock relative to demand growth. So while the gold price in USD reflects macro confidence shifts, the silver price reflects both macro stress and physical tightness. This combination is powerful. When demand surges into a supply system that cannot quickly expand, prices don't move gradually. They gap, they spike, they overshoot. And that's why understanding supply is critical, because when silver moves, it's not just reacting to sentiment, it's reacting to scarcity. And scarcity in a leveraged financial world can trigger explosive price acceleration far beyond what most models predict. Now let's address something that scares people out of silver at exactly the wrong moment: volatility. If you've watched the gold and silver price in USD over the past few years, you've seen it. Sharp rallies, sudden drops, intraday swings that feel irrational. Silver especially has a reputation for being unpredictable, and that reputation causes hesitation. But here's the truth. Volatility in silver is not weakness, it's energy. Silver is a smaller market compared to gold. It takes less capital to move it. When institutional money rotates into precious metals, gold often absorbs the first wave because it's deeper and more liquid. But once momentum builds, capital begins flowing into silver. And that's when moves accelerate. Because the silver market cannot absorb large flows smoothly, prices jump. They don't glide, they leap. This is why you'll often see gold rising steadily in USD while silver lags, and then suddenly silver surges, outperforming dramatically in a compressed time frame. It's not random, it's rotational pressure, it's positioning, it's traders and funds adjusting exposure when they sense that the monetary cycle is shifting. Now here's where it becomes psychological. During explosive phases, pullbacks can be violent, 5% down in a day, 10% retracements after a breakout. For the unprepared investor, that feels like collapse. But in high momentum markets, volatility is the mechanism that transfers silver from weak hands to strong hands. It shakes out over-leveraged traders. It resets sentiment. And then, if the underlying drivers remain intact, industrial demand, supply tightness, macro uncertainty, the next move can be even stronger. Gold's volatility tends to be more restrained. It is held by central banks, sovereign funds, long-term allocators. Silver behaves more like a hybrid, part monetary metal, part industrial commodity. That hybrid nature amplifies its reactions. When inflation data surprises the market, gold may tick upward methodically. Silver can spike. When dollar strength temporarily pressures metals, gold might drift lower. Silver can drop sharply, only to rebound faster when sentiment shifts again. The key is understanding context. If gold and silver prices in USD are fluctuating during periods of rising global debt, currency uncertainty, or accelerating industrial consumption, volatility may signal accumulation rather than deterioration. Big players don't enter quietly. They build positions in phases. That process creates whipsaws. And let's be honest, markets rarely reward comfort. The cleanest, calmest charts often mean the move is already mature. Silver's volatility, while uncomfortable, is often present in early and mid-cycle expansions. Historically, some of the largest percentage gains in silver have come after extended periods of choppy consolidation. So when you see sudden drops, don't just see fear. Ask whether the structural drivers have changed. When you see explosive upward spikes, don't just see euphoria. Ask whether capital is rotating aggressively into the sector. Volatility is not the enemy of opportunity. In silver, it is often the signal that pressure is building beneath the surface. And when pressure builds long enough in a constrained market, it doesn't release slowly. It releases violently. Now we zoom out. Because silver does not explode in isolation. It explodes when the macro environment creates pressure. And right now, that pressure is building. When you look at the gold and silver price in USD, you're not just looking at metals. You're looking at confidence. Confidence in currencies, confidence in debt markets, confidence in central banks. And when that confidence starts to crack, capital looks for shelter, Start with inflation. Even when official numbers cool temporarily, structural inflationary forces remain embedded in the global system: supply chain realignment, energy transition costs, rising wages, sovereign debt servicing. Inflation erodes purchasing power quietly at first, then suddenly. Investors who understand this don't wait for headlines. They reposition early. Gold typically reacts first because it is the primary monetary hedge, but silver follows, and when it does, it often moves with greater velocity. Then there's the US dollar. Since gold and silver are priced in USD, dollar strength or weakness directly impacts their charts. When the dollar weakens, metals become cheaper globally, increasing demand. When the dollar strengthens, metals can face temporary pressure. But here's the bigger picture. Long-term currency stability depends on fiscal discipline, and global debt levels are at historic highs. Servicing that debt in a higher rate environment strains budgets. If policymakers pivot back toward easier monetary policy to stabilize growth, that can reignite upward pressure on precious metals. Interest rates are another key lever. Rising rates initially pressure gold and silver because they increase the opportunity cost of holding non-yielding assets. But if rate hikes slow the economy too aggressively, markets begin pricing in future cuts. And once investors anticipate easing cycles, gold and silver often front-run that shift. The market doesn't wait for the announcement. It anticipates it. Now layer in geopolitical risk. Trade tensions, regional conflicts, energy disruptions, supply chain fragmentation. Every time uncertainty spikes, capital flows toward tangible assets. Gold has historically been the first responder. Silver, due to its smaller market size, can react more explosively once momentum builds. And here's something crucial. Central banks have been accumulating gold at record levels in recent years. That signals a desire to diversify away from excessive dollar exposure. While central banks don't typically accumulate silver in the same way, their actions support the broader precious metals complex. When gold strengthens structurally, silver's probability of upward revaluation increases. So when you see the gold and silver price in USD moving sharply, understand the backdrop. It may reflect inflation fears. It may reflect expectations of monetary easing. It may reflect currency stress or geopolitical instability. Often, it reflects a combination of all of the above. Silver becomes particularly sensitive when macro pressure aligns with industrial tightness. That's when monetary demand and industrial demand synchronize. That's when moves accelerate beyond typical cycles. Macro stress is not a single headline. It's a buildup of imbalances. And when those imbalances reach critical mass, capital moves fast. Silver doesn't just respond to the moment, it responds to the system. And when the system shows strain, precious metals rarely stay quiet for long. Now let's talk about sentiment, because markets don't move on data alone. They move on belief. Right now, the battle between bullish and bearish sentiment in silver is intense. And when you watch the gold and silver price in USD swinging back and forth, what you're really witnessing is conviction colliding with doubt. On one side, the bulls see structural forces lining up. They see industrial demand climbing year after year. They see tightening supply. They see massive global debt and fragile currencies. To them, silver isn't just a trade. It's an undervalued asset in the early stages of repricing. They point to historical cycles where silver lagged gold initially, then suddenly outperformed in explosive fashion. They believe volatility is simply the market preparing for expansion. On the other side, the bears argue that silver is too volatile, too speculative, too sensitive to economic slowdowns. They warn that if growth contracts sharply, industrial demand could cool. They emphasize rising interest rates, stronger dollar phases, and the risk of investor fatigue. They see spikes as overextensions. They see rallies as opportunities to sell strength. This tug of war creates instability in price action. Every rally faces skepticism. Every pullback sparks fear. And that tension produces the choppy behavior we see in USD charts. But here's the deeper dynamic. Markets often climb when disbelief is still present. If everyone were already convinced silver was headed dramatically higher, the move would likely be mature. Instead, we see divided opinion. That division suggests positioning is still adjusting. It suggests the market has not reached euphoric consensus. Sentiment indicators often shift rapidly in silver because it's a thinner market. Retail investors can become enthusiastic quickly during price surges. Futures traders can flip from net long to cautious in short order. Headlines amplify moves, social media accelerates narratives, but beneath the noise, longer-term capital moves more methodically. Gold typically anchors the precious metals complex. When gold strengthens steadily in USD, it builds a foundation. Silver's sentiment then becomes a leveraged reflection of gold's trajectory. If gold continues gaining institutional support, bearish arguments against silver weaken. If gold stalls, silver sentiment can cool quickly. What makes this moment particularly interesting is that bullish arguments are rooted not just in speculation, but in structural themes: energy transition, monetary uncertainty, fiscal pressure. Bears must argue either that these forces are temporary or already priced in, and that's the core of the battle: pricing. Has the market fully priced future demand? Has it fully priced macro instability? Has it fully priced supply constraints? No one agrees, and that disagreement is fuel. Because markets move the most when consensus breaks. As long as sentiment remains divided, silver retains the potential for sharp directional moves. If bullish conviction grows while supply remains tight, upside acceleration becomes possible. If macro conditions temporarily stabilize, bearish voices may regain strength and push prices lower in USD terms. But understand this. Sentiment doesn't exist in isolation. It responds to data, policy, and price itself. And when price begins trending persistently, sentiment usually follows. The question isn't whether bulls or bears are louder today. The question is, which side will control the narrative when the next major move in gold and silver prices in USD unfolds? Now we arrive at the most important question of all. What happens next? Because watching the gold and silver price in USD explode is one thing. Understanding where it could go from here is something entirely different. Markets move in phases. They accumulate quietly. They break out aggressively, they correct sharply, and then, if the structural drivers remain intact, they expand into full cycles. The key right now is identifying which phase we're in. If gold continues strengthening in USD, that's your first signal. Gold is the thermometer of monetary stress. When gold trends steadily higher, it often means capital is repositioning defensively. Silver, historically, lags in the early stage. But once confidence builds in the precious metals complex, silver can enter what traders call the acceleration phase. That's when percentage gains begin to outpace gold dramatically. One metric to watch closely is the gold to silver ratio. When that ratio is elevated, it suggests silver is relatively undervalued compared to gold. When it compresses rapidly, it often signals silver outperformance. During previous major cycles, sharp ratio contractions coincided with powerful silver rallies. If we see gold firming while the ratio begins to fall decisively, that could indicate momentum is shifting. Another factor is physical inventory levels. If industrial demand continues absorbing supply while investment demand grows, available above-ground silver tightens. When physical markets tighten, paper markets eventually reflect that stress. Premiums rise, delivery times lengthen, volatility increases. Those are early warning signs of structural strain. Macro data will also guide the next move. Inflation surprises to the upside, metals could react positively, signals of monetary easing. That could weaken the dollar and support gold and silver in USD terms. Escalating geopolitical tension, safe haven flows increase. On the other hand, if economic contraction reduces industrial output sharply, silver could face short-term pressure even if gold remains resilient. It's important to understand that explosive markets rarely move in straight lines. Even in strong cycles, silver experiences violent corrections. Those corrections often feel like the end, but historically, they've sometimes been pauses within larger trends, so the path forward depends on alignment. If industrial demand remains firm, if macro stress persists, and if gold maintains strength in USD, silver's probability of continued upside expansion increases significantly. If those elements weaken simultaneously, momentum could cool. But here's what makes this moment unique. Multiple drivers are active at once. Industrial transformation, fiscal pressure, monetary uncertainty, supply rigidity. That combination does not guarantee an endless rally, but it creates conditions where sharp repricing becomes possible. The market is watching the same indicators. Traders are tracking rate expectations. Investors are monitoring inflation data. Institutions are analyzing global liquidity conditions. Everyone is trying to anticipate the next shift before it becomes obvious. Because once it becomes obvious, the largest percentage moves are often already underway. Silver doesn't send invitations before it moves. It revalues quickly when conditions align. So when you watch the gold and silver price in USD from here, don't just ask where it is today. Ask whether the forces beneath it are strengthening or fading. Because the next phase won't announce itself politely. It will emerge through price.